You're watching Silver News Daily. Subscribe for more.
The Fed today is too political, too prominent in credit markets, and too powerful. Can the chairman of the Federal Reserve be fired by anyone? By anyone. The argument is, well, not by a president, by Congress, by the people. Here you have someone with so much power in a position to channel financial rewards to some segments of society at the expense of others, who can make interest rates be zero so that people who save a little bit every week in their bank account get zilch.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. The U.S. is quietly preparing to shatter the foundation of the global financial system. Behind closed doors, whispers of gold-backed bonds are growing louder. And if those whispers turn into action, it could trigger a financial chain reaction the world hasn't seen in a century. For decades, the entire system has run on one thing: trust in the U.S. dollar. But that trust is crumbling. The Fed is under fire, political pressure is boiling over, and investors are fleeing fiat faster than ever before. So where does the smart money go when confidence dies? It runs, not walks, straight to silver. Silver, the underdog of precious metals, is suddenly finding itself in the spotlight. With gold breaking records and the dollar sinking to new lows, silver is beginning to surge, and this could just be the beginning. Because if America truly abandons fiat, the ramifications will be global, and silver's role in the new financial order could be bigger than anyone expects. What's really happening behind the scenes? Why is silver positioning itself for the ride of a lifetime? Let's dive in.
It's on a good, solid footing. We're in the middle of a critical transformation, which is always has an element of risk, but I think it'll be well validated. We need to do something. We were entirely too dependent on government spending, and that means overspending. So from a fiscal point of view, it's readily noted that we were on an unsustainable path. And I think under the Trump administration, it's clear that we've charted a new course aimed at empowering the private sector and trying to unleash the energy of individuals who haven't had financial assets, who haven't been beneficiaries of an economy that was becoming increasingly financialized, increasingly dominated by the latest Federal Reserve Act or even statement. So I think that we'll end up a more powerful, more solid economy, one more true to American principles, if I may say, that are based on individual liberty, lower taxes, less regulation, making the private sector the engine of the economy and reflecting those American values. So I'm optimistic in the long run, but I recognize that the transitional part of this is challenging. A high level such as yours, which look at macro and micro issues, we live and breathe this. But it's interesting. I guess you could dismiss it as anecdotal. But I watch shows, I try to make myself watch shows that just show what I might call everyday Americans, maybe being interviewed by a moderator who's walking through a diner and they're eating breakfast. And they're quite pleased with the way the Trump agenda is unfolding. They're more comfortable with the emphasis on personal security, looking at immigration issues and trying to limit fentanyl as a threat to our people. And I think that they will stay the course with President Trump, even as he pursues these tariff policies, which to the financial world are immediately categorized as causing uncertainty, which is then seen as the worst possible thing you can do. And yet at least 40% of the American population, the ones who maybe don't have portfolios connected to stock market performance are applauding it. And they sense that our country has been somewhat hollowed out in terms of manufacturing capabilities, all those jobs and factories that disappeared, I think, under intense, unfair trade pressure. Those wrongs are now being addressed. And I think they believe in the idea of fairness. So I applaud what the Trump administration is trying to do. I would love to have a tariff-free international trading system.
The cracks in the Federal Reserve's armor are no longer just hairline fractures. They're gaping wounds, and the markets are taking notice. For decades, the Fed has enjoyed a veneer of independence, protected from the political storms of Washington. But that illusion is fading fast. In recent weeks, investor confidence has been shaken by explosive headlines. You see President Trump threatening to fire Fed Chair Jerome Powell, public spats over monetary policy, and whispers of a complete overhaul in how the central bank operates. When the guardians of fiat currency are caught in a political tug-of-war, faith in the system starts to break. And when that faith erodes, the escape route becomes clear: tangible assets, and more specifically, silver. We're not talking about a temporary blip in confidence. We're talking about a fundamental shift in sentiment. The U.S. dollar index has plunged to levels not seen since 2022, while the 2-year Treasury yield has collapsed, falling over a full percentage point. These aren't just numbers, they're warning signs. They scream instability, they scream uncertainty, and every time investors hear those screams, they rush to safety, and silver is increasingly becoming the destination of choice. While gold may be the traditional safe haven, silver's unique position as both a monetary and industrial asset gives it an edge when markets panic. The Fed's credibility is being dragged through the mud, and the world is watching. Meanwhile, silver's trajectory is shifting. It's no longer just reacting to inflation or interest rates. It's reacting to chaos at the top of the financial food chain. If the institution charged with maintaining currency stability is itself unstable, how long can the fiat system hold? Silver buyers aren't waiting to find out.
20%, those tariffs could be exquisitely tailored to address these wrongs from the past that have had negative consequences for our economy. They can be overwhelmed in 10 minutes of trading in foreign exchange markets. So I think, like Paul Volcker, our former Fed chairman, who always said you can't worry about tariffs without addressing these currency shifts that affect the terms of trade more radically and with more uncertainty than a proper tariff regime could rectify. I'm in that school of thinking, free and fair trade. And actually, I remember in 2016 in September, I had an op-ed in the Financial Times, and in the end alluded to having some kind of an international monetary conference at Mar-a-Lago. And my idea was that wasn't in the immediate plan, but President Trump has always said you need to think big. And if we're talking about, so often when you discuss tariffs, what happened to the rules-based post-World War II system, let's go back and see what that was really about. And it was about the Bretton Woods International Monetary Agreement, which was hammered out in July of 1944. And the main rule of that International Monetary Accord was that other nations who wanted to participate in trade and investment relationships with the United States would maintain stable exchange rates against the dollar. And by stable, I mean they had to stay within 1% above or below a pre-stated exchange rate value with the dollar. And the dollar, in turn, was to anchor the system by being convertible into precisely $35 per ounce of gold. That was the convertibility rate. That was official. And that option was available to the central banks of the countries who wanted to participate in this system. It was only after Congress agreed to setting up this system that they went on to then address how do we reduce tariffs. So first you had a stable international monetary foundation, and then we set up the General Agreement on Tariffs and Trade. So that was signed about a year and a half later. So I think it's a mistake to think that you could treat the trade with tariffs in isolation.
Imagine this. The U.S. Treasury announces a new issuance. Only this time, it's not your average government bond. It's gold-backed. For the first time in generations, the government pegs its debt to a physical asset. That single move would mark the beginning of a financial reset unlike anything we've seen in modern history. The fiat era, built on promises and printing presses, would start to unwind. And as the dollar retreats from its throne, silver wouldn't just benefit, it would explode. Gold-backed bonds aren't just a nostalgic throwback to the Bretton Woods system, they're a declaration of war on fiat money. If the U.S. begins anchoring its currency to gold, global markets would instantly recalibrate. Currencies, commodities, even equities would have to reprice against a new monetary standard. And in that moment of recalibration, one asset class stands poised for historic revaluation: precious metals. While gold would rise, silver would surge faster. Why? Because silver is gold's shadow in bull markets, moving later but with twice the intensity. But there's more. Introducing gold-backed bonds would send a shockwave of credibility through hard assets. Investors would scramble to reposition, not just for safety, but for outsized gains. And silver, sitting at a massive discount to gold, would be the ultimate leverage play. This isn't speculation, it's strategy. As fiat currencies wobble and central banks flirt with gold, silver's appeal multiplies. In a world returning to sound money, silver is no longer just a hedge. It's a core asset. The reset is coming, and silver is ready to lead.
Era when countries were debasing their currency against the common reserve asset, which was gold. So the world had been on a gold standard, but to gain a trade advantage, countries were changing the rate at which they would convert their currencies into gold. And as soon as they made their currencies cheaper, we called it a competitive depreciation, although there was really nothing competitive about it. It wasn't competing, it was cheating. Because when you make your currency cheaper relative to the export market target, their currency, or relative to this neutral reserve asset gold, which all the countries were using to establish the value of their own currencies, you're changing price signals. You're making your product cheaper in the export markets, and you're making exported products more expensive in your home market. I do think it would be healthy if we used gold as a common denominator, as a reserve asset. That is, I don't necessarily need to fault Mexico, our largest trade partner, although I could, for depreciating the peso against the dollar 23% last year. I mean, I consider that alone grounds to apply a tariff just to even things up. But I'm willing to say, well, Mexico and every other country is free to pursue their monetary policy in a way that they think best serves their own national economic objectives, but they should be prepared to say if that gives them an unfair trade advantage by cheapening their currency relative to our currency, and yet they want to export to our markets, there must be an adjustment. So we can just call it no fault currency depreciation, because of course they do have the choice. They could orient their monetary policy to target a stable exchange rate with the dollar. But I'm not saying they have to do that. It's their choice. It's just they can't have plausible deniability. Same for all the countries. If you allow the currencies to constantly change, I mean, money is a measure. So if the measure is changing and it's to the advantage of a competitor, because you're going to judge their performance in different terms now, that's just inherently irrational, I think. That's what undermines the basic principles of free trade. I'm completely for having trade based on comparative advantage. I think that works to everyone's benefit, but it has to be based.
Silver's always played second fiddle to gold, but that's exactly what makes it so dangerous when it starts to move. Because when silver wakes up, it doesn't walk, it runs. And right now, it's stretching its legs. While gold dominates headlines with record-breaking highs, silver remains deeply undervalued, trading at a gold-to-silver ratio north of 100. Historically, that ratio never lasts. And when it snaps back to the mean, silver doesn't just catch up, it erupts. We've seen it before, in 1980 and 2011, and now all the signs point to it happening again. What makes silver so explosive isn't just the monetary panic, it's the industrial engine behind it. Silver isn't just a store of value, it's a utility metal. Solar panels, electric vehicles, semiconductor manufacturing, this is an optional demand, it's structural. And when the monetary system starts to wobble, silver gets hit with a double wave. Investor demand and industrial consumption both spiking at once. That's the perfect storm. The problem? The market is still asleep on silver. All eyes are on gold. But silver remains the high-leverage play that few are watching, yet. As soon as the floodgates open and the narrative shifts from gold's strength to silver's opportunity, the repricing could be violent. We're not just talking about a move from $30 to $35. We're talking about silver ripping through resistance zones and entering a new price era. Silver is no longer the underdog. It's the secret weapon for those paying attention.
Floor from Milton Friedman. And so I was very interested in the fixed versus floating exchange rate debates of earlier times. And I tended to align more with Robert Mundell, who felt that gold should be a component in a new international monetary system. He thought we should have adjusted the Bretton Woods system instead of just ending it in 1971 under President Nixon. And I'm certain Milton Friedman would hate what his idea of freely floating rates has turned into. For one thing, you have countries, let's just look at China, who accumulate dollars. Many countries do this, accumulate dollars as reserves so that they can completely reverse any market tendencies that would affect the impact of their own currency. So if we're going to have freely floating currencies, because that's some kind of a free market approach, then I would say, first off, you have to forbid governments from intervening in currency markets, from having reserves that they can spend to change the value of the exchange rate, because obviously you're not going to get a free market solution. I bet you most major central banks would be very much upset if they thought that currency swap arrangements with the Federal Reserve would be suspended. And I'm not suggesting they would, but there's another example where the fact that our Federal Reserve, if there were a disruption in the exchange rate between the dollar and other currencies, and other major central banks asked to be given or loaned massive volumes of dollars that they could then pass on to their own central banks to give to their private clients, and we would have no say as a monetary anchor, as a surrogate for the real economy. I think that would send a powerful signal that the U.S. would be prepared to live by some kind of rule or some kind of market assessment that wasn't just a faith in a Federal Reserve chairman or in the Federal Reserve's ability to keep delivering slightly inflationary expropriation of the value of purchasing power as part of its deliberate monetary objective. I think that people would be drawn to a Treasury security that offered gold convertibility. And otherwise, go back to Treasury. The Fed is required to remit its earnings back to the Treasury, and that would plug a lot of holes in our own fiscal outlook. But instead, the Fed is making those payments to banks on their cash accounts, and 42% of those cash balances are held by foreign banks. Another 40% held by our very largest banks, and only 18% held by our smaller banks, the ones that actually make loans to the private sector.
The U.S. dollar is unraveling in real time, and silver is feasting on the fallout. The dollar index has plunged to a 3-year low, dropping below 98 and showing no signs of support. Meanwhile, the 2-year Treasury yield has tumbled more than a full percentage point, a move that screams distress across bond markets. What we're witnessing isn't just weakness, it's a signal that confidence in the U.S. currency is disintegrating. And in its place, silver is being rediscovered as the ultimate hedge against fiat collapse. You see, fiat currencies rely on one thing: belief. Belief that governments will maintain fiscal discipline, belief that central banks will act independently, belief that the debt can be repaid. But right now, all three of those pillars are crumbling. The government is flirting with trillions in additional spending, the Fed is embroiled in a political firestorm, and debt levels have reached unsustainable extremes. Against that backdrop, investors are waking up to a hard truth: fiat money is failing. And every time the dollar falls, silver doesn't just rise, It absorbs that fear and turns it into fuel. The recent surge in silver above $32.80 isn't just about technicals, it's about capital flight. When bonds lose their appeal and the dollar loses its credibility, investors don't just look for yield, they look for safety. And silver, with its dual identity as both money and metal, becomes the perfect target. This is a systemic shift. It's not about a dip or a bounce. It's about a larger movement away from paper promises and toward physical assets. The fiat system is leaking confidence, and silver is stepping in to fill the
idea that I'm borrowing from Alan Greenspan. He wrote about gold-backed bonds in the Wall Street Journal in September of 1981. And he thought it would be a good idea because it would put pressure on Congress and the White House to not engage in deficit spending. He thought that if the yield on gold-backed bonds was lower than on conventional, traditional, we'll call them nominal treasury bonds, that would send such a powerful signal that Congress would essentially be embarrassed towards spending less and moving toward a balanced budget. What I'm finding now is the concept of the fact that gold has increased so much in value. Since 1973, the United States, which is the world's largest holder of gold reserves, we have 261 million ounces, has been carrying those gold holdings at a book value of $42.22 an ounce. So now at $3,300 an ounce, there's a massive windfall profit in there, approaching $1 trillion. What I think would be very smart and what would serve as a barometer on U.S. progress on both the fiscal and the monetary front toward a balanced budget and a dependable dollar would be to have a much longer term treasury offering. And I say 50 years because I think the perfect time to launch this was long before President Trump started talking about ushering our country into a golden era. And also for the sake of the world economy, I think he's quick to add. I now think that next year, when the U.S. will be celebrating its 250th anniversary of the Declaration of Independence.
The technicals don't lie. Silver is heating up, and the chart is screaming breakout. Hovering just below $33, silver has reclaimed key Fibonacci levels and is now staring down a crucial resistance line at $33.11. If it breaks through, we're looking at a clean runway straight to $34.87, with minimal turbulence along the way. But this isn't just a chart pattern. It's a reflection of the massive sentiment shift that's now gripping the silver market. Bulls are awakening, and they're not waiting for confirmation. They're positioning for acceleration. Let's break it down. The 61.8% Fibonacci retracement from the March swing high has been conquered, and silver is finding consistent buying support around $32.55, a level that's now acting as a technical springboard. Oscillators on the daily charts are tilting decisively upward, and the momentum indicators are flashing green across the board. This setup doesn't just favor the bulls, it begs for follow-through. Analysts across the space agree. Once silver pushes past $33.11, the floodgates open. But there's something even more telling: the gold to silver ratio. Sitting above 100, this historic divergence is a red flag for one thing: silver is overdue, way overdue. Every time this ratio has spiked this high, silver hasn't just corrected, it's gone on a rampage. We're not talking about a slow grind higher. We're talking about a violent snapback that redefines the price floor for months, even years. And traders know it. That's why volume is surging, why the dips are getting shallower, and why resistance levels are getting softer. The technical stage is set. The question now isn't if silver will break out, it's when. And when it does, the move could be fast, furious, and unforgettable.
It would be long for us, but it was considered. When I was on the transition team, when the first Trump presidency was about to be inaugurated, I was assigned to Treasuries, lead advisor on international affairs. And 30-year bonds were discussed, 50-year bonds were discussed. And Treasury just wasn't sure whether there would be investor appetite for that. I think if you added this gold convertibility feature, there would be tremendous investor appetite. And it would be highly symbolic. I mean, look at our outstanding debt. If we even can start reducing the deficit spending at the end of this 10-year window down to zero, if we can actually get to just a balanced budget, if you can imagine, which is now the stated goal of the Trump administration, we still would have, we would need all of the next 30 years to start paying back. While people who have can afford to or use margin accounts to purchase the stock market can make tremendous gains. I think that people feel the system has been rigged in favor of big investors, big corporations, big business, and big government. And I think the money has to work the same for everyone. The way the Fed works today is it monetizes the debt, which represents the overspending, the deficit spending, which is why the government has to go into debt to pay in excess of the amount of revenues received by the government. So the Fed monetizes that, which allows the fiscal payments that go directly into the pockets of people. We certainly saw that during COVID. We see all of these transfer payments to, in many cases, able-bodied people who nevertheless have figured out how to game the system of receiving subsidies from the government, so that increased purchasing power causes inflation. We saw it exceed 9% in fairly recent years. We saw nobody fired at the Fed for that. So there's your lack of accountability.
Geopolitics just threw gasoline on the fire, and silver is catching every spark. As tensions between the US and China surge to new highs, the markets are going defensive, and silver is reaping the rewards. President Trump's tariff blitz, including a sweeping 10% baseline duty and targeted rates as high as 145% on Chinese imports, has reignited fears of a full-blown trade war. China's retaliation was swift and sharp, accusing the U.S. of trade bullying and warning other nations not to bend to American pressure. The result? Global trade anxiety is spiking, and so is demand for hard assets. Silver's safe haven status isn't just theory anymore, it's back in play. In times of geopolitical instability, money flees the unpredictable and flocks to the tangible. And in today's market, nothing embodies tangible security like silver. Unlike fiat currencies that can be devalued overnight, or equities that can be whiplashed by policy changes, silver is physical, borderless, and liquid. It's no surprise that as global headlines grow more volatile, silver has clawed back to multi-week highs and is pressing toward its technical breakout levels. But here's the kicker. Industrial demand could suffer in a prolonged trade war, right? That's true, but that's already priced in. What's not priced in is the renewed monetary demand. As investors realize the trade war could drag on for months or even years, the pivot towards silver as a store of value becomes more pronounced. And with central banks, institutions, and even retail investors all chasing the same small pool of physical supply, the result could be explosive. The geopolitical narrative is no longer a background noise. It's the soundtrack of silver's rally. As Washington and Beijing dig in their heels, silver becomes more than a commodity. It becomes a shield. And right now, that shield is shining.
3.5 trillion in cash. And when the Fed says we're raising rates or lowering rates, when they say we're sticking at our current rate, it means they're going to continue to pay 4.4%. That's quite a hefty return on a risk-free, government-guaranteed cash deposit that a bank keeps at the Fed. And I think if citizens knew how much of the $610 billion, which the Fed has paid out to these private companies, banks, as I say, 42% of it going to foreign-owned banks. If the public knew, then at what point would I be indifferent to getting either the face value denominated in dollars for this bond or some market value of gold, likewise scaled up 2% a year, let's say. You could set it up that way. Or you could put, it just depends what value. You have to have a face value on the bond. If you put today's market price of gold and then told people, if you purchase this, you're either going to get $3,300 or an ounce of gold in 50 years, what would they pay for that? I think now you're talking about the interest rate comparable to, say, a 50-year treasury bond without that convertibility plus the value for acquiring gold. So it's just pure demand. Gold is becoming more popular in exchange-traded funds in the United States. So a lot of gold was imported to the United States to be part of an investment option for people in the United States that involves physical possession of gold. But I also think that the fact that big wholesale outlets like, say, Costco, very popular with American buyers, are making it easy to purchase gold. And I think a lot of people see it as a good alternative, as a good addition, say, to their investment portfolio, and they're comfortable with it. I have always seen it as a surrogate for the integrity of our currency, but there's no official link there. That's why I hope there will be in the future. But you have former central bank chairmen such as Alan Greenspan referring to gold as the only real global currency. And I think to the extent that the dollar is under some duress, that may also be reflected in a higher price for gold.
While the financial chaos and geopolitical turbulence set the tone, it's the supply side that turns silver's story from bullish to explosive. Because behind the headlines and the charts lies a tightening noose, and it's all about physical scarcity. According to the Silver Institute, global silver supply in 2025 is expected to reach 1.031 billion ounces. Sounds like a lot until you look at demand. Projected consumption is 1.148 billion ounces. That's a deficit of over 117 million ounces. And it's not a one-off. This marks the 5th straight year of structural shortages, and there's no sign of relief ahead. What does that mean? It means every ounce matters. Every uptick in demand, whether from investors seeking safety or industries racing to electrify, drains a well that's already running low. And with inventories thinning, the price pressure builds. Silver isn't just an undervalued asset anymore. It's an overconsumed one. From solar energy to electric vehicles to 5G infrastructure, the modern economy is guzzling silver faster than it can be pulled out of the ground. And don't forget, mining production isn't exactly booming. Years of underinvestment, regulatory hurdles, and geopolitical instability in key mining regions have stunted output. While gold mines have attracted capital and scaled up, silver has been left behind. That lag is now becoming a liability for the system. Because once demand for silver investment spikes, there's no backup plan. There's no hidden warehouse with extra bars, just a shrinking pool of physical silver and a growing wave of buyers. This is the squeeze, not the meme stock kind, the real kind, the kind that ends with a price chart that looks more like a rocket launch than a market trend. And the market is starting to catch on. Smart money is moving, inventories are tightening, and the deficit isn't closing, it's widening. If silver breaks out technically, the supply crisis becomes the accelerant. And when that happens, there's no telling how high it can go.
Is it correct to have a rather small committee of monetary officials decide, literally dictate, what should be the cost of capital? And I say dictate because I'm going back to this instrument the Fed uses, its tool for conducting monetary policy. It no longer does it the way Paul Volcker did. The Fed doesn't intervene so much through open market operations, where it would really have to engage with suppliers of capital and those seeking capital. It doesn't try to influence the rate of treasuries by buying or selling treasuries from its own portfolio. It primarily just states, we will pay this rate of interest on bank reserve balances.
Everything is converging. The monetary system is cracking, the political theater at the Fed is spiraling, global tensions are reigniting, and silver is being pulled into the center of it all. The stage is set for something historic, a return to sound money. And as whispers of gold-backed bonds get louder, it's no longer just about gold, it's about what follows. Because when the old system collapses, silver won't be an afterthought. It'll be a cornerstone. A new financial reality is forming, one that punishes fiat excess and rewards real tangible value. And silver, still trading at a fraction of gold's price, represents the most asymmetric opportunity in that shift. With the gold-to-silver ratio flashing extremes, deficits locking in year after year, and price levels perched just below breakout resistance, silver is balancing on a knife's edge. All it takes is one push, A policy change, a market shock, a geopolitical event, and silver could surge in a way that shocks even the bulls. This isn't about catching a trade. It's about positioning ahead of a generational monetary reset. Those who wait for confirmation will miss the move. Those who understand the signals already know. Silver isn't just reacting to the collapse. It's a response to it. If you're watching this and seeing what's unfolding, don't look away. History is being written in real time. The fiat era is fading, and silver is stepping into the light. Make sure you're prepared for what's coming next. And if you want to stay ahead of this financial transformation, don't forget to subscribe. This is not financial advice. Please consult a professional before making any investment decisions.